Okay, hello everyone. Let me stop that music. Yeah, this is me, Guillaume Lambert. I'm here with Nathan Burks from the Panoptic research team. This is Beyond the Greets, so research insights from the Panoptic team. Nathan has prepared something very cool for us. But first of all, hey Nathan, how are you, and how did you manage the past few days of market turmoil? Oh, I think you muted. Sorry.
Okay. We
Yes.
good? Yeah.
Yes.
Okay. Um yeah, faring okay. Crypto showed resiliency into Sunday and then kind of capitulated. Yeah, just interested to see the carryover into fundraising season. That's
It's all a tactic. I mean, the boomer, the TradFi markets have somewhat recovered today. I think so. Again, prices have been moving. The VIX is down too, which is good. Who knows what's going to happen over the
this
few?
might be a relief rally, but
Does
there's
it?
still a bit of an illusion, but we have no certainty yet.
So I don't want to do any predictions, but then we've seen a similar thing in 2008, where it was going up and down quite wildly.
Mm.
Same thing with 2020. One colleague from my previous career, Jeff Gore from MIT, biophysicist like I was, but he did some studies of population fluctuations in terms of crisis. So it was bacteria fighting against one another, or he cod the population of the coast of Cape Cod and the Atlantic. But the years or the moments leading to population collapses is when you have these super wild movements. So there's an intrinsic instability that shows itself when again there's a collapse, a crash about to happen. So
Oh, sure. Chaotic systems are all the same. So
because
whether in finance or in biophysics.
and I would the bugs, the bacteria, they have no idea what they're doing. They just do the best. So that's what is maybe a bit more fundamental than traders. But yes,
Mm-hmm.
the the dooming or the doom coming yields to what may seem like up and down, up and down, up and down, but on average it's maybe going down. So it, as you say, maybe a relief rally, maybe something persistent, maybe it's fine. The administration is a genius, everyone will cave in, or maybe not, who knows. But yes, it's been
Yeah.
kind of okay to trade TradFi options for sure, because again, to some extent, today is a rally, so it made up for some of the losses. The crypto markets as well. We talked about it yesterday, but there's a few accounts that did pretty well. Most people may be
Mhm.
now in the money in terms of what they sold, but yeah. Um, but yes,
It's
let's get in.
actually a nice unintentional segue into what I'm talking about today.
Exactly. Now let's see how this ties in back to research. And yeah, I think yeah, Phil, I can have you share your screen. I think you've prepared a short presentation for us dealing with volatility. But yeah, I'm eager to learn more about this. So is this a new piece, or this is based on an existing research by
It
that we've
is. It's a new piece. It kind of expands and broadens off a piece that was written quite a while ago, comparing Black-Scholes premia to Streamia and showing how, like, if you shorten the range factor, so shorten the expiry of our perpetual options and heighten the pull volatility, the Streamy accumulates far more than the comparable Black-Scholes model. And this is kind of narrowing the scope of that to put wings and seeing how IV translates to the Streamy accrued by those put wings. But it all
amazing.
starts with two fairly universal concepts in TradFi volatility trading, which is the volatility risk premium and the volatility smile, interrelated. I mean, this image right here shows the further out you get from the current tick, the implied vol seemingly goes up. Same in TradFi with the skew or volatility smile. Deeper you get out of the money from a strike price, the implied vol tends to rise. The volatility risk premium is not all that dissimilar from that, which is that the further you get out of the money, the premium from IV to realized volatility grows. So particularly in the put wings. So that's kind of the conceptual foundations of upon which this is built. And to start, these are 10 delta options that were back tested, by the way. Um, you can see, I know the chart's kind of jumbled at the bottom, the premium chart, but the what I found with ETH in the ETH 30 bips poll necessarily was that there's almost a direct one-to-one correspondence between the IV in terms of the spikes and the timing between the ETH 30 bips IV and when the premium spikes for these 10 delta puts, because you're having increased demand to the downside, a demand for optionality. So the with our spread multiplier, this is factored in with our spread multiplier, that Streamia concurrently grows with it. But this isn't always the case. Now, granted, this is the most traded asset on Uniswap, so which is directly proportional to RIV. So you see additional volume, you see a concurrent rise in our Panoptic native or Uniswap native IV, and the premium grows accordingly. And this is about a 4-year span from May of 2021 to March of 2025. So you, like I said, you see a rise in demand, rise in the premium, volatility risk premium, and accordingly, you see a rise in the streamia as well. So this pattern tracks pretty much exactly from a visual perspective with ETH. But as I said, not always the case. You go to the next slide. There's a correlation between WBTC IV and premium, but the proportionality is not the same in the timing. What do I mean by that? If you look at the first spike, which is, I think, in May of 2021, right around when USDT or USDC decoupled, hence the added volatility, you do see a spike in premia for the WBTC pool, but it's not to the degree like the spike in the premium is the largest, but it doesn't have the same spike in IV you saw with the prior slide. I'll go back to the prior slide for a second. You see that like the biggest spike in IV matches up with the biggest spike in premium. Um, Whereas with WBTC, the biggest spike was somewhere in 2024, late 2024, in terms of IV, but you didn't see the biggest spike in premium as a result of that. And as we consider crypto to be a subset of commodities, there are various different idiosyncrasies that and risk premia that affect different commodities in different ways. So, and also this is a less traded asset. So, um, is that a coincidence? I think not, because uh, the less volumes you're going to see, the less IV, less stringent I or less severe IV, and I don't think the coupling with the premium is going to be as strong. And that's what I go over on the next slide, which is okay, higher cumulative returns, ETH monthly puts, or the sum returns of this strategy selling 10 delta puts in either asset uh, sums up in that same period to about 153% for ETH, 108% for BTC. So they're both very lucrative.
And maybe can you
Uh,
go back a little bit? So the 10 delta is offset by quite a bit, right? So this means you're
yes.
barely touching it from the upper range. There's a lot of range below like your the price, but is it also held by for 1 month, or how is this kind of rolled?
Yes. The monthly returns are summed up over that period.
Okay, because you
Um,
can imagine if it's a bull market, it's going to leave the range and not earn much. And if you were to do a
yes,
50 delta put, the premium might be even higher. I guess that's kind of my point too.
yes.
Okay.
Um, and ironically, and I think this is a unique feature. I'm glad you mentioned that. I think this is a unique feature of our options. I like if you test in the wings of the 10 delta puts or 10 delta calls, you see it's a very lucrative strategy. But if you go to the ATM, it's even higher. Um, which is a unique, which just means there's more demand. And that's kind of a unique feature of Panoptic from the standpoint you don't see that in other asset classes. You almost see a smile with the volatility risk premium, whereas in Panoptic you have that added spread multiplier reflecting demand, directly reflecting demand, and can monetize it. You're going to see more profit in really that center range. But as I said, higher IV to Streamia correspondence. That's my label with ETH. So I don't think it's a coincidence you see higher sum returns. Now, what are some of the underlying factors causing this that are unique structurally? Um, I personally think JIT LPs are one of them. Now, let me explain through the valence or through the lens of being super short-term perpetual option sellers, which is, I believe, how you describe them, Guillaume. They're just collecting, they're feeding that pent-up demand when there's downside jump risk. So they're kind of whatever analogy you want to use, like piranhas when there's blood in the water. They just come in, swarm, and capture that situationally heightened volatility risk premium, and then blunt the price impact subsequently. So the IV spikes down. So that's why you see the heightened vol with the Uniswap IV as compared to, say, a D-vol. Um, Going to the next slide, though, it's really this is from a research bite that you wrote on first exit time. So this is the annualized vol. This is 1 year of our sample period.
So I
So the
was
entire
revisiting that
calendar.
chart too. I think I posted something yesterday about the implied volatility of Panoptic, but someone asked about the realized vol, and I realized again a lot of what the realized volatility is a weird type of measure as well, because you have like block by block, trade by trade data, and
Mhm.
unless you have kind of a way to compensate for these short time scales, sometimes you have multiple trades in the block. It's hard to generate something accurate, but that's right. Revisiting this, the first exit time might be the best way to actually measure the realized volatility of these
Yeah.
of an asset over time.
And this is really to show like the volatility within these pools is caused like any other markets by macro catalysts, but at the same time, that's the initial spark, so to speak, or the initial flame, and then the JIT LPs are moss to the flame to um, accommodate that pent up demand. The problem is in a forum like Uniswap, uh, there is no opposite side of the trade. Is the problem. You can only accommodate it by longing options in the demand is going to be supplied through a platform like Uniswap, where you can actually long the opposite side of that supply. And maybe if Uniswap's volumes grow enough, the Uniswap IV won't be quite as volatile itself. You see what I'm saying? Because you're going to have demand to actually come in. You're going to have the opposite side of that flow to come in and actually balance out the short term super short-term put sellers, the JIT LPs, depressing that IV so rapidly. So it's kind of similar to, we were talking about gamma traps last time, the DOVs, market makers front running the DLVs and crushing IV. We could potentially do that if the volumes grow enough.
Yeah, it makes a ton of
But
sense. Again, yeah, and then yeah, the way you do JIT is very atomic and very very kind of your own funds in, your own funds out. In Panoptic, you can do it as well, kind of not on leverage, but you can like do all of the trade, borrowing, deploying, collecting your fee, closing it in a single kind of platform, which is kind of neat. But yeah, I'm excited to see the first JIT options trade
mm,
ever be realized on
yes,
Panoptic. And it doesn't need to be
and
adding liquidity. You can imagine you see a huge price move in the next 12 seconds. You can buy a bunch of calls maybe. And also profit on
mhm,
this side. This is kind of a cool
yeah,
thing.
exactly. But Uniswap, there's no recourse to balance out this infusion of supply. So this leads to some key takeaways, which is that selling wings is de facto selling tail risk insurance or downside jump risk insurance. And hence, you see this in TradFi. It's just translating it to DeFi here. Um, and really, that's where the JITs are attracted. They're trying to accommodate all this downside jump risk demand. So they come in. The problem is there's no opposite flow to that, like I just mentioned on the last slide. So higher demand equals higher volatility risk premium, like higher IV over RV situationally translates to higher premium for us, option sellers. BTC and ETH differ in reflecting it in the sense they both have their own idiosyncratic properties, as they're both commodities. So the volume profiles are going to differ. And they all both have their both individually distinct risk premia that factor in other ways, and also idiosyncrasies, I should say. Um, like I've mentioned several times, the JIT LPs are just swarming in to capture this volatility risk premia. Uh, and there just needs to be a platform to accommodate the opposite side of that flow. And but as a result of all this, the Uniswap IV has elevated jump risk itself because you see these macro catalysts come in, and then these JIT providers ride the wave or JIT LPs, and they're really just going super short term gamma. And jump risk is best proxied by gamma. So what if the price moves against them? It's just going to explode even more to the upside. Um, I don't know how much that's actually the case, but where the price moves against them, but that could definitely happen.
And maybe
Um,
also JIT,
I'll go
just in
ahead.
time liquidity for a while was something that everybody was a bit afraid of, but it still is. I don't know if it's an up to date, but can you go back to the chart that shows which fraction of all
Yes.
trades are JETs? Because it's still somewhat minimal. Maybe if it's an ETH USDC 30 bips, it's less
Mm.
than the other ones. But yeah, it's I don't see
But
the
as I
y axis. What's
tried to
the
harp on, they're really situational predators. From the sense
yes.
like they're not trying to do this every time. They're trying to do this off a macro move, and then they can swoop in and ride the wave, so to speak.
Yeah, very very cool. But yeah,
But
it's like a few percent, fraction of a percent of jets. But yeah, all right.
but
Um, mhm.
yeah, that's it as far as my presentation goes.
Amazing. Yeah, thanks a lot. So again, a lot of the concepts that we see in TradFi are applicable to Uniswap and Panoptic. There's always a twist, of course, and this is what Nathan
Mm.
has told us about today. But yeah, this is very very cool. So, all right, thanks very much. Let's see. And yeah, so I think that's it for now. So this is again another installment of Beyond the Greeks. I think Amy will be presenting next week. But yeah, this is
Mhm.
something that is very, very important to get across, which is options. Again, they may seem complicated, but there's a lot of nuance to them. And again, we try to make them a bit clearer here in these research pieces. So yeah, pay
Yeah.
attention for what we have over the next few weeks.
Yeah, it's just about trying to translate like um you might be saying like, okay, you could sell puts and collect the premium because LPs are selling put options. You might be able to collect the premium, but it's not going or this tail risk insurance from selling this tail risk insurance, but you're not going to be able to confine it to moneyness necessarily.
Yeah.
So these added nuances are only available on a platform like Panoptic. And also, there are different structural factors that come into the fold that you don't have to consider in TradFi, like a JIT, like the Uniswap IV being as jumpy as it is as a byproduct of these market participants. So, just things to bear in mind as to why uh, put wing selling in uh, DeFi could even be potentially more lucrative.
All right. Okay. So that's it for this week. Thanks very much, Nathan. And yeah, well, I guess I'll see you here, the audience, on Wednesday. We do the Stop Losing, Start Trading show again with options hours too. And yeah, next week will be Amy also presenting some pretty cool stuff. So, all right. Thanks a lot, everyone. And yeah, have a good day.